to take permission from Axiom AI. I'll provide you the website link once it's up and running. Okay.
Okay, okay. Then
Sure.
I think we'll stop recording. I will just we need few screenshots of this of the talk.
No, that's fine. You can go ahead and record. We'll
Okay. Yeah.
sort it out later. Okay.
Yeah.
Fine. So yeah, as I said, we will be discussing data analytics in finance. And it's going to be a brief session, right? We're not going to delve deep into any topic. It's going to be a smooth run, and most of the topics are just what we use in day-to-day life, and it could be a revision for some of us. All right. So the agenda for today would be just an introduction of finance, and then let understand the evolution of money, like how it has uh, grown, how it became formed to what it is in the current day, why it is a driving force in our daily lives. Yeah, it's a brief session again. So following that, I'll give you an overview of current financial industry, what's happening, and what will happen in the future. All right, and then we'll transition into specific to banking industry, and then we'll discuss briefly on the products, life cycles, and regulations. And as a case study of a banking product, we'll pick up credit card, and we'll do a deep dive of credit card life cycle. All right, and while doing this credit card life cycle, I'll also talk about what kind of analytics goes into each stage of this credit card life cycle. Sounds good. Let's go ahead. And For the people who have joined late, if you have any questions, kindly drop them in the chat, and Sharath can moderate. Right? Thank you in advance. All right, let's get started and doing a very textbook thing of defining finance. Right? Finance, what it is. It's basically management, creation, and study of money. So, however complicated the product or the tool or investment methods or markets be, it eventually boils down to this one-line definition of management, creation, and study of money. All right. Broadly speaking, finance is again we do day-to-day finance, which is personal finance, right? And then corporate finance is mostly what bigger institutions deal with. And then there is public finance, which usually governments or anybody like a central banking institution like RBI in India deal with. So that premise falls under public finance. Corporate finance again is institutional, right? Personal finance is what we do in a day-to-day life. All right. With that, let's get started with how the money evolved and what it is in the current day. And so to the very basic, so our known system of transfer of attaching a value to something started with the barter system, right? Which started way back in 6000 BC. And so, as you know, barter is not a it could not be a fair system because I might not be equaling the same product to something. Like, say, suppose I have a flock of sheep, I want to exchange it to something for me to eat, but that might not be a fair transaction in barter system because there is no set standard. So if you look at each product or each tool, how it got developed, it's trying to improve on the previous things, right? From barter, it became physical objects. Like people were attaching objects like copper or maybe iron. So coins came into existence because of this, right? They wanted to attach some standard to or value to what we are selling or buying from physical objects. And then when bigger kingdoms evolved, it was difficult to govern these physical objects concepts, right? They introduced paper money, which was easier for them to govern. It was also easier for them to control. Like only certain group of people or certain governing authority or body can do so. Earlier, in case of barter or physical objects, anybody could have done that, right? If I own something, I create something, I'm literally creating money. So, so that got transitioned into paper money, and that is the concept of money that we know today. Like we attach some value to it, and we exchange these papers called money in exchange of goods, right? And from paper money, it would still not be able to control, right? I can print as much of money as I can want, right? So to mitigate that, what institutions started doing is they started equating it to the gold standard. What is a gold standard? So say suppose I am the RBI, I will we only able to print so much money as I have gold. Like if I have say 1 kg of gold, I will print only equivalent amount of money. What is one kg in INR? I would print only that much of money. By money, I mean currency in the form of paper or coins, and I would circulate only that for my economy. Right? That gold standard set in I mean early 19th century, and it still is followed, right? It still is followed because gold is a rare metal, and there are rarer metals, but we are not going to delve into that. So and around 1950s, this concept of spend now pay later came in. The reason for that is, look at the timelines, and you will get to know. So 1950 is just after two world wars, right? After two world wars, world economy was crippling. Governments did not have any money to spend on, and they could not even make policies, right? So to increase their ability to pay, or their circulate their economy more, what do you need? You need to make people spend. One of the concepts for that introduced was credit cards. So we all know how credit card works. We'll get into the details or nitty gritties of it. Basically, you spend first and then you pay later, right? In 1950, just after a World War, it was a huge benefit for people, right? So it quickly caught up in US and UK, which were the most affected countries there. And this kind of spending eventually stabilized their financial systems, right? Uh, and Speaking of credit cards in India, right? We are still a saving economy rather than a spending economy. So we try to save first and then only spend. So that kind of mindset is not there in the Western side, where they usually splurge and then they try to pay off. And uh, not to diverse too much, yeah. So credit card penetration in India is still very at an nascent stage. This is going to change, hopefully, not exactly in the form of credit card, but some sort of spend now and pay later, right? From then, in the last couple of decades, we saw um, um, money becoming digital, right? So if you take the case of after demonetization and the UPI advent in India, we hardly see paper money. We hardly use coins or paper. If anyone who is owning a smartphone also has these digital apps like banking apps and UPI apps, so you don't get to see your money. So that is why it's called electronic money. Uh, so yeah, the electronic money, because it also decreases the spend of central institutions like RBI, right? You don't have to print so much of currency since usage is less. You can reduce your currency. So the equivalent amount of gold would still exist. It's just that it's not circulating in paper currency. It's circulating in different form, like in a digital format, right? And just to add, UPI was a technology that we have not mimicked from any Western countries or any other country. It's in-house built technology that Western countries are looking to adapt now. So we have leapfrogged from mimicking Western countries to pioneering technologies that is accessible to everybody. So we are a uh, billion people country, right? So governing billion people country is different from Western countries, right? So uh, so as I was saying, the easier the mode of money, the better you can circulate or better you can spend. All right, that is the case for now. So what is happening in the future? Though with the advent of blockchain, right? This is a pretty catchy term in these days. With the blockchain, Bitcoin, Ethereum, all these coins have come up, which are called as cryptocurrencies, and we'll discuss later again why it's a valuable concept and why it's not something of a hoax, right? So going forward, we might see a huge surge in cryptocurrencies and adoption of cryptocurrencies for every government, right? That's a brief of uh, how money got evolved. Any questions so far? All right.
No one.
Yeah, yeah. Let's move on. Uh, so let's try to define the market in financial industry today, right? How can we broadly categorize them? So one would be the institutions which govern them, like central banks, private banks, and companies that are providing insurance. Those are called financial institutions. These guys are the rule makers. They basically create or facilitate our services, facilitate this movement of money, right? Financial instruments, like what are these? Basically assets like real estate, stocks, or even bonds, right? And financial markets are basically a marketplace where you can trade these instruments. So to simply, as an example, so financial institution example would be banks or these gold loan companies or LIC. LIC is an insurance provider. It would still categorize as a financial institution, right? What are the financial instruments? So financial instruments, you can take a quick look, although the picture is small. So cash is one instrument, real estate, derivatives. Derivatives, when I mean derivatives, those are the bonds, stocks, or commodities, those kind of derivatives. And fixed income securities or these government bonds or gold bonds, right? And equity is your shareholding in a company, right? What are the markets? I've only picked share markets for simplicity. So these are the this is how very high level classification of how we can do a financial industry classification. All right. Uh, Moving ahead. So if you see today, we are in a transformational change, right? Let me go back to this slide. If you notice, from the bartering system to gold system, it took us thousands of years to come to that stage. But from gold system to cryptocurrency, it didn't take much time for us. It's just a couple of hundred of years, right? So and in the past couple of decades especially, the transformation has been phenomenal. So that's why I'm saying we are living in a transitional phase of finance industry right now. As an example, uh, try to concentrate on the left part first. This is the uh, data for top 10 financial institutions as evaluated by Center for Financial Technology and Entrepreneurship. Right, this chart is owned by them. All right, I just picked up for our purpose. So 2010, if you take a look, all top 10 financial institutions were banks. It could be central banks like in the case of China, or private banks like in the case of US, like JP Morgan Chase, Wells Fargo, HSBC, Citi. These are all private banks in US, right? So all 10 were banks. So now when you see in 2020, these highlighted red boxes, right? These are platform business models. You see right away in a span of 1 decade, Visa and Mastercard have become the top financial institutions, and so is 600, which is PayPal, Ant Group, and Tencent. Ant Group and Tencent are from China again. Ant is the major financier of lot of startups, including our Paytm. So that's why you will see a lot of similarities in the business models, right? So why is this transformational change happening? So in a traditional bank setting, e- even with the advent of digital banking, right, the innovation in the products was not happening. So if you take the case of PayPal, right, it has immensely made it easy for people to use money, right? PayPal is similar to any UPI app, say Google Pay or Paytm. So as say Paytm, so I can instantly transfer money to whoever I want to. Although that happens with the banks too, but it's a quite tedious process, right? So as and when you innovate the products and make things easier, uh, it would improve your value chain, right? So take the example of Visa and Mastercard. What are they like? What do they provide? So Visa and Mastercard are payment gateways. Like whenever we are doing any transaction on a debit card or a credit card, that data is definitely flowing through one of these guys, Visa, Mastercard, and in the case of India, it's RuPay, right? That's the reason. So irrespective of which bank you are, you had to go through one of the Visa or Mastercard or American Express, things like that. That is why there is a lot of value attached to this in the recent terms. Going forward, we might not see the same value attached to Mastercard and Visa. These are struggling companies. Just 2 years from 2020, which is this year, they are struggling to keep their value intact because of the advent of lot of startups that have come up, and also the one of the reason is cryptocurrencies, right? Moving ahead, basically that's the so today we are sitting, this framework is what we are sitting in, centralized or private banks, and then platform business models or startups that are coming up that are making our life easy. All right. So what's going to happen in the future, right? Traditionally, what we were discussing so far is called centralized finance or CEFI, right? What happens if I am the person who wants to send it to my friend? I have to go through a bank. It could be my bank, and then I mean multiple banks could be involved. And these payment companies are nothing but Visa and Mastercard, like we discussed, right? Or in-house systems that if it's the same bank, it could be an in-house system, right? We call it a centralized finance because we cannot bypass this system of banks. This system that is established worldwide, it is more or less the same. Like there will be a central bank like an RBI, like Fed in US. So they will govern everything, including your payments and everything. So it's impossible to bypass this system. That is why it's called centralized finance. So what's going to happen in the future, right? It's already happening, but large scale adoption would happen only after a few years, right? It's called decentralized finance system or DeFi, where it's taking advantage of the blockchain system, right? And what happens with blockchain is you cannot commit fraud, or you cannot impose any rules because your credibility instantly goes down, right? So how it's enabling is because of these advantages, the transparency would increase, and if some form of blockchain is set up with higher integrity, right, then it would benefit a lot of people. So, and also one more factor of favorable factor for DeFi is the anonymity of who is sending to whom, and that's a huge advantage, right? Although there are downsides, but it's a huge advantage to larger population. So what happens in a framework? If I want to send, the receiver would directly receive, but we are not going through a central banking system or where there are no rules. So if you are aware of the central banks, right, they come up with all kinds of nonsense policies, right? Take RBI for example, they've done demonetization uh, without doing a due diligence of how much it would impact the public, right? That kind of scenarios would go away with a decentralized finance system, and hopefully we will see this kind of a system in our lifetime. All right, let me see if I missed something. Yeah, so one of the major factors is timestamping of each transaction, right? So in this blockchain technology, you would get to know, like you cannot manipulate the information, so that is why the transparency would increase. All right, that's the only point I think we missed. Any questions at this point? I know this is a lot of information download.
Yeah, Vamshi, so when you said that there is you cannot manipulate the data in decentralized systems,
Yeah.
like how it is done in centralized systems, and on like when I'm doing a
So
transaction, the timestamp will be there even there, right? So
yeah, so basically, in a centralized system, at some point or the other, people are involved, right? And these people are decision-making people. Like, say, a case study of HSBC Mexico. So what they have done, they have facilitated transactions of these drug dealers. Like, they've legitimized drug dealer money to enter into the legal system, right? That happened only because there was no transparency of what was happening in HSBC, right? This came to light only because there was a whistleblower who publicly published this information, and then he got all kinds of in all kinds of troubles, right? So as I'm saying, one private bank has done one such instance, right? That kind of a scenario cannot happen in a blockchain, because multiple parties are involved, and then you will not know like who is evaluating your transaction, right? That information is anonymous.
Okay, so if I assume the data is stored in every system, something like that, the data is stored in every system, so
In
you cannot.
decentralized finance, yes.
Okay, okay, okay,
Yeah,
okay. Thank you.
sure. So one more example for the same thing is the recent case of Wells Fargo opening multiple accounts on customer's name, right? Say if I have an account with Wells Fargo, without my knowledge, multiple products account were opened. Like they opened a personal loan, they opened a car loan on my name, and multiple savings account or credit cards without my knowledge or without my approval. So that kind of fraudulent activities will also be avoided using a DeFi, right?
Okay.
Shall we move ahead?
Yeah, yeah.
All right. Any questions from the students? All right. Let's move ahead. Uh, so that actually concludes overview of my finance. Let me quickly recap what we have gone through. So we have defined finance as management, creation, study, and of money and investments, right? So if you come to this thing, even in the case of a complicated system like a blockchain or Bitcoin, it would eventually boil down to the same definition, right? It's the study of or creation of and functioning of the money, right? That definition applies everywhere, wherever a financial product is being created. All right. We have also seen like how to evaluation of money. This is a very basic thing which you have learned in school also. How to categorize, like what kind of players or what kind of tools are there. Institutions are the players, markets are the places, and instruments are the tools, right? These are the very generic examples. And then, as an example, we have seen how transformational finance industry is, right? It's just going through phenomenal transformation. So if you see, just to reiterate, like what used to be a top five financial institution is not even in the top 10. Like Wells Fargo was used to be a top five institution in 2010. It's not even featuring. Same with the Citi, right? Citibank, right? So things like that. Uh, and where are we going from centralized finance? So one point I would like to add here is as these cryptocurrencies and decentralized finance system is settling in, lot of centralized agencies like RBI or Fed, US Fed are really trying hard to adapt to that change, but there's no clarity or there's no what do you say? There's no roadmap for them yet to implement that in their frameworks, right? Recently, in the finance budget, our finance minister had said that a digital rupee would be launched utilizing a blockchain technology. But how it would happen, there is no roadmap for that yet. It's a far away concept still, right? Similarly, JPMC has launched a digital currency for them, which is still going through a lot of transformational changes. So yeah, we are still in a formative years of adapting to DeFi, but we might see this change in our lifetimes. Okay. All right. Going to a specific example of financial industry, I would pick banks, right? So these are relatable, and also because of my past experience, I'll be able to better talk about this. All right. Uh, so think of a traditional bank. How does it make money, right? Don't even think of a bank. Like if you are a money lender,
Vamshi,
how?
yeah,
Yeah,
yeah.
sorry.
Sorry to interrupt. So I have one question. Like when RBI is introducing digital currency,
Yeah.
there are some of the it becomes more. Is it going to become more transparent, all the transactions?
So think of it this way, right? This digital rupee, it's not they're saying that they will use blockchain, but the regulatory authority or the governing body would still be RBI, right? So I really can't say that there will be as much transparency as in Bitcoin or in Ethereum, but digital rupee also would still be, in my view, would still be categorized as centralized finance.
Okay.
Although
Yeah,
it's
I don't
utilizing a
see any difference.
blockchain,
Like
yeah,
if RBI is introducing, I don't see any difference between digital rupee or
and
UPI.
physical rupee. Yeah, correct.
UPI.
Yeah,
So actually, there is one
it's
question from,
sure.
yeah, yeah. Please carry on. Yeah. There is one question I will try to ask. So this is from Dr. Subhashini. What is her question is, we are entering passwords during online transaction. Is it safe, or any person can track it?
No. Passwords are completely safe. And also, if you have noticed recently, this captcha system is getting extended, right? They're asking you for more and more different kind of securities, while in addition to the password, they're asking some more information, right? So that is how they are tackling. So traditionally, how it happened with internet banking is there was only one factor authentication, like you enter only the password and then you are in the system. That was easier for somebody to get hold of. Not specifically, I'm not talking about institution per se, I'm talking about a third party. It could be a digital hacker or a social engineer who would just get it out of you. From a one factor authentication, we have moved on to a two factor authentication, right? And in countries like India, you've also got this OTP kind of a system where, in addition to the password, you can also enter an OTP. So safety wise, I don't think it's an issue. uh, but this kind of OTP setup would not work in the West world. Just a point I would like to make, because people in the West want everything simplified. So if you're just using any tool, it should not ask them to do the work. It should be easier for them to use.
Yeah.
So it's
Uh,
absolutely safe, to answer your question. Yeah.
yeah, on continuation to that, Dr. Subhashini is asking, then how hackers are playing?
So that is happening through the medium that you are using. So suppose you are using a browser or say if your PC is not up to date or your firewalls are not done, anybody can enter your system easily, right? It's not happening from the institution side. It's happening from a third party thing. As I said, it could be a browser, it could be a PC, it could be a mobile. Uh, so comparatively, Androids have lesser security, right? So if you want to use it on a mobile, I would suggest you invest on a VPN, trusted VPN, and then use the banking apps.
Yeah, thank you. I hope that answers the, Dr. Subhashini's question. If not, please let me know. Let us know, ma'am. There is one more question from one of the other participant,
Sure. Yeah.
Fadia Zeel Kaushal. India is also creating its crypto money. So will that also be controlled by RBI?
So that is exactly the point I'm making, right? So let me give you an example. Like in any industry, regulators usually catch up after uh, a product or a company is set up. Say, for example, what to take bike taxi, right? There was this concept called bike taxi introduced by Rapido, and Uber and Ola immediately adopted to it, right? What is that concept? Like you can ride a two wheeler as a taxi. Like there is a driver on a two wheeler, and then he will drop you anywhere you want. This was a new concept for state governments to grapple with. So they had no existent policy at all to deal with it. So anybody who owns a bike could become a bike taxi driver, right? So some states, no, most states still don't have any regulation for bike taxis. Only states which are uh, like Telangana, Karnataka, and Delhi have and Maharashtra have set up some governing rules for this bike taxi. So the point I'm trying to make is whenever something is getting some new product is getting created, right? There most likely will not be a regulatory framework for it already existing. So what governments do, they try to catch up. So as and when the product evolves, and then they will introduce something. So other example is this e-commerce sites, right? There's still no clear policy for us for e-commerce. So as and when new products come up, these governing rules or governing bodies do come up. But in India, government is really wary, so they're really cautious on cryptocurrencies. That is the reason why they're hugely discouraging crypto investing. They've even taxed 30% of on your crypto profits, right? In the recent budget, this was announced, and it immediately came into effect. Unlike many other policies which take time, it immediately came into effect, right? So they just are against this concept. The main reason is because they don't understand this concept, right? They can't keep enough checkpoints for them to have control. That is the reason why there will be stricter norms in India. And just to add to that, so to answer your question, yes, there will be definitely regulations. At least in India, we cannot have a liberal cryptocurrency like in the West. It would be in some form governed for sure. So just to add to the point that I was making, the other reason for this is because there is no financial literacy in India. So most people, even people with higher educational degrees, right, they don't have financial literacy. Uh, 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 the point I was making, the personal finance, right, the day-to-day finance. So because of that, as and when you see these jazzy terms, people are running to make money. Like we've seen numerous news of bitcoins, right? It went from 0 to 50,000 in just 1 year. People have become like multi-millionaires. So when you see this kind of news, because of the lack of financial literacy, people run and try to take advantage of this. And if you see in the even in the crypto world, right, 90% of cryptos are crap. So you cannot find a legitimate product and invest it. So that is also one of the reason why Indian government or central RBI is very wary of cryptocurrencies in India. Yeah. Did I
Vamshi,
answer your
so,
question? Yeah.
there is a follow-up question
Sure.
from Fadia itself.
Sure.
So there will be no. So what is the doubt is that will there be transparency if they intervene?
So see. The lack of transparency is what we are suffering from Indian central bank, right? So if you have seen all these frauds that are happening for the past 4 5 years, these are not happening instantaneously. These have been happening over the years, and the main reason for that is India hasn't adapted to technology like other people have adopted, right? Other banks in the West have adopted, and it's still people driven or people oriented processes in the, at least in the public bank sector. In the private sector, there are transformational changes have been brought by HDFC. So HDFC is a pioneer in Indian market. That also the reason you don't hear frauds or this kind of non-performing assets cases in the case of HDFC is because they have a stronger technological setup, and then they also stringently follow regulatory guidelines. All right, that is the only differentiation between that private HDFC bank and the public banks. These public banks still, because it's still a people-driven this thing, it's there definitely is a lack of transparency. And if you have seen this scam 1992, you will get to know how people get easily manipulated, right? Even foreign indirect investors also get manipulated. So yeah, if some form of cryptocurrency which is governed by a central body like RBI comes in, then transparency could still be questioned.
Yeah, Vamshi. So there is one more another question from
Sure.
Ananya. Ananya. So
Yeah,
how
go
is
ahead.
blockchain preventing identity theft?
Identity theft is mm, not sure if I can answer that question effectively. If you want, I can get back to you, Ananya.
Okay. Okay, Vamshi. Thanks.
Sure. All right.
That's it.
Yeah.
That's it for now. You
Okay.
can.
Okay, sure. Let's move ahead. So let's move ahead with the specific example of banks, right? So as I was saying, take an example of a traditional bank like SBI. How do SBI make money? Like SBA has this huge potential of savings that people go and deposit the money, and it gives you a rate of interest, right? Say for example, right now it's around 4 to 5%. So that is SBI is paying you. On the other end, what it does, it gives you loans, and this type of loans has exploded in the past decade, right? There used to be very straightforward home loan and a personal loan previously. Now it has exploded into a lot of multiple things like a vehicle loan. You can even purchase premium sports goods like a race bike. There is a specific type of loan for that even in India. So these kind of things have exploded. So what it does on these products that it has invented, it will charge you a higher rate of interest. So and this difference of rate of interest, like what it is earning from the money that it is giving out and what it is paying you for savings account, is their working capital, right? That is how traditional banks used to work. And banks, uh, so if you briefly, if I can stress on banks, there was no concept of a public bank before Indira Gandhi. So Indira Gandhi had nationalized all these banks, made them all government banks, and this change has only advent of uh, private banks only happened later stage. All right. So once they became public banks, like governed by government, lot of like unlisted things used to happen in banks, right? There was no regulation, and banks till uh, today they still dance to the tunes of governments, right? And there's no they cannot function as an independent company, or they cannot envision a growth like HDFC is doing, right? That's a brief introduction. So as I was saying, banks nowadays have these kind of products like personal loan, vehicle loan, and there are other nowadays. Credit cards penetration is increasing in India, but it's still at a very nascent stage. And now private banks are coming up with these digital apps where they will just do your pre-registration, and then you can use it as a credit card. Like you can spend it on for online transactions and then pay it back later. So this was exactly what I was saying, like spend now, pay later. So all the financial institutions would try to push you to spend more, right? As you spend more, uh, their ability to make money out of it would increase, right? So that is the reason why credit cards or all these kinds of loans are a major products for banks rather than a savings account or a fixed deposit thing. Uh, Although savings and fixed would give them a standard, what do you call? Uh, they would give them the authenticity to work with, like if any bank is having so much of savings account with them or the fixed deposit with them, that they can show it as a security. It's their security. All right. So these are very familiar with us. I'll be moving ahead. So since there are multiple products, right, and this in this age of information overload, banks deal with a lot of types of risks. So like this is applicable to Indian and Western markets everywhere. So broadly, I've only listed six, but there are over 30 types of risks that you can think of. Uh, Credit risk is something that comes up only when you think of products like loans or credit cards. For savings and fixed deposit, it doesn't apply, right? Because credit risk is you are offering credit to somebody which they can spend, and the risk here is they might or might not pay you back. All right, and it is on you to basically judge the ability of a customer to pay you back. It's called ability to pay. It's a standard term. All right. Market risk is arising because of see in if you think of a global scenario, no government or no financial institution is working as a sole entity, right? Everything is connected. That is the reason why if Russia is going and attacking Ukraine, our stock markets here have fallen, or the world over, because it's everything is connected, export import supply chains to global stability and uncertainty. That is the market risk, basically risk arising from the market, or the macroeconomics, you can say, uh, things that governments change overnight. Something is happening in Sri Lanka right now, because of the huge inflation, right? That is a market risk. So operational risk is something our Indian banks could definitely implement. This is basically inconsistent. This kind of risk arises because of inconsistencies, right? Inconsistencies from your processes, people, or your mechanisms. So take for example the PNB, Punjab National Bank, and Vijay Mallya. This thing. So PNB had that. It's a pure case study of operational risk because people were involved. People were manipulated and taken advantage of, and also the processes. There was no checkpoints, enough checkpoints for them to counter that kind of a fraud. All right, that all those kinds of things fall under operational risk. Liquidity risk is, say bank owns a lot of assets, um, and in some, say someday it has this challenge of liquid. I mean, it needs money and it can't spend. Everything is in fixed assets. So that kind of scenario cannot arise with a huge bank. That is one of the regulations. We'll talk about it more. But liquidity risk is basically your inability to have liquid funds with you, right? Reputational risk is basically, so say if I'm running a bank or a firm or a, say suppose an app like Zomato, right? Reputation matters to me very much because it runs on, it purely is a reputational game there, in the case of startups. But the same thing applies to bigger entities like banks also. So say suppose if I am an account holder with Punjab National Bank, I came to know that there was a huge fraud. I would be wary of doing business with them in the future, right? So I would move my business elsewhere. I might choose a different bank, or entirely stop dealing with PNB altogether. So reputation is a very valid risk. And also legal risk, if you're using any, uh, basically legal risk is multifold. Like it can come from customers, it can come from entities, it can come from your copyright infringements, or you are just not following enough regulations. So legal risk might arrive. So I've only listed 6, as I said, and these are most familiar terms also. So we will be talking about credit risk in detail. Any questions at this point? Because we will be diverging our topic a bit.
No, Vamshi. Okay.
Sure. Let me quickly review again banking overview. So, these are the products of a traditional bank, right? What they offer, and then these are the risks that come with operating a bank, right? So, from these products, I'm only picking up credit card. We will do a deep dive study of how. I mean. Uh, Study of how, what is the life cycle of a credit card and how payments happen. All right. Uh, so this is a case study from this thing, right? Banking products. It starts with acquisition. So before even starting with the life cycle, let's understand what is a credit card, right? Credit card is, so all of us, anybody who owns an account in India will definitely have a debit card. What is a debit card? You are only spending the equivalent amount that you have in your savings bank, right? So that part is very clear to us. So what is a credit card on the other hand? So banks issue credit cards to customers, uh, not all of them, only eligible customers, where they assign some limit to you. Say, if you have say 10,000 limit on your credit card, so you can only spend that much or multiple of that much amount, right? Usually how it works is, you make the spends in this month and there will be a bill date where all the transactions will be accumulated and that bill will be generated for you, and then you'll have some grace period for you to pay. Usually the standard is 21 days. It could be less in India. Some people also follow 18 and 15 days rule also. So basically the concept is they're encouraging you to spend first and spend for that to spend. You have certain limit attached to your credit card, and once the bill is generated at a billing date, you have some grace period to pay it back, right? That's the concept. And if you pay back in time, then you are called a transactor. And if you are carrying your balance forward, there will definitely be fees and charges for that, right? So you will be called a revolver because you are revolving a credit again and again, right? So the credit card life cycle, I I usually like to call it as life cycle, although it is not a cycle as per se. So it starts with acquiring new customers, right? Say you are a bank, you are a lender, money lender, and credit card is your product, right? You want to give it out to some people. Say there are 10 people, out of which you can only give it to 2 or 3 people. Like, how do you judge they are good or bad? Let me just do this. So in acquisition stage, all these eligibility checks happen, right? Are you eligible? Ability, your ability to pay is good. Are you a trustworthy customer? And also fraud checks would also happen. If this particular person has a previous record of fraud, then it would be a strict no-no, right? All this happens at the acquisition stage, where companies are getting new customers on board. All right, it's a simple concept, just like any other app or a company, right? From acquisition, once the customers pass this eligibility criteria, they come on board. It's called an account management stage. Right. So what happens in account management means you acquired customers or existed customers are already on your books, all on your bank books, right? Now you have to manage them effectively. So what happens in that, you have to take care that people are not forgetting to pay. That comes under account management. You should take care that people are spend. You should have a track of how people are spending, the patterns, and uh, you also devise some strategies, right? So say some person's credit limit is 10,000. Say for example, each month he's using 10,000 and he's also paying back 10,000. So what would you do? You see potential in this customer. His scores are good. Everything is good. So you do this credit limit increase, right? You increase 10,000 to 15,000 or 20,000 so that he can spend more on your card. All right. So that kind of strategies all come under account management. All right. Sorry. Yeah. So from the account management stage, what happens? We will again go in depth for each of these concepts. I hope this topic is interesting or exciting for you. It's a late afternoon session. Please bear with me for a few more minutes. Yeah. Yeah. So from in account management, anybody who is paying on time would still be on your books, right? He's an ideal customer. He's a good customer for you. He's also a positive for your bank. Uh, there will eventually be a concept called delinquency because some people fail to pay. So when people fail to pay, you have certain buckets. We'll go in detail to that. When it's called a delinquency, like failure to pay is called a delinquency, and this will be reported to credit bureaus and all. We'll come to that again. So from delinquency stage where you're not paying, you move in buckets like 30 days past due, 60 days past due, meaning you haven't paid for you have used the amount, you haven't paid for the last 30 days or 60 days. And in the US, it's a standard like after 150 days, that account is written off. When I say written off, it's a loss for the company. Like it's no longer on the books. So they will take that amount which the customer had failed to pay as a loss. They book that loss. And even in the write-off stage, a lot of strategies go in, like if you can give a payment uh, help, right? Like converting their due into EMIs. So US is very prone to these cyclones, right? Usually whenever cyclone hits a part of state or this thing, most of the banks offer customers that you can pay your outstanding in EMIs, right? So that kind of flexibility comes in during delinquency or write-off stages. All right. Once you booked your losses, say you already written off that particular account, so how do you still make some profit out of it? You sell that account to third party. Say third party, there is a collection agency. This is a familiar term for us in India, but there are collection agencies, companies specifically for this reason of collecting money from written off accounts, right? Uh, and they cannot do this forceful thing that Indians do. So this third-party company which is buying accounts, let's say, suppose my bank has incurred 100 accounts in this month. I will sell those 100 accounts to this third party. That third party, based on the outstanding, say cumulative of all these 100 accounts, 1 lakh is owed to me, to the bank. The third party would buy it for say 10,000. So bank is benefiting because out of all the written off accounts, you're getting some amount back, and the third party will try to recover as much as they can from the customers, right? So that's the credit card life cycle. All right, let's delve. I'll come back to this each concepts again, but let's also understand how a credit card transaction works because it's a very complex system and multiple parties are involved, right? Um, so uh, just take a break of 2 seconds. I'll start. Okay. All right. So say you are a user, you are using your credit card at a shopping complex or somewhere. So what happens? This information is
Vamshi,
going. Yeah. Yeah. Sorry. Sorry.
if you are tired, you can take 5 minutes break. It's okay.
No, no, I'm fine. I'm just. It's too much of information for the students, right? So I'm just taking
Okay.
a break.
Yeah,
Yeah.
yeah, fine.
Yeah.
Carry.
We can continue, right?
Yeah, yeah, yes.
Okay. Sure. So coming back, so this is how one each. This is an example of one transaction how it processes, right? So say you are an user, you have swiped your credit card at a machine wherever it is, supermarket or shopping mall somewhere. That order through the merchant's website. Say suppose you're doing it in a Reliance Trends or Big Bazaar. So this Big Bazaar website would ping will try to ping through Visa or Mastercard. These payment gateways charge be or nothing but Visa or Mastercard or Amex. These are facilitating agencies for the transaction to go through, right? Why are they the facilitating agencies? Why doesn't the bank have this infrastructure? Multiple reasons, right? Because Visa or Mastercard is tied up with all the banks. So if you're talking about just one bank, other banks are not willing to share that information with you. The other thing is infrastructure cost is huge. Visa and Mastercard have spent a lot on their infrastructure, and that is why they are market leaders today. All right. So coming back, you have swiped the card through the merchant website and through Visa and Mastercard. It is pinging the merchant's bank, right? What this merchant bank does is they try to connect with the bank issuing bank. What is issuing bank? This is the bank where the credit card is issued. Say suppose you are doing this transaction using a HDFC card. Issuing is bank is nothing but HDFC bank, right? This merchant bank is pinging the issuing bank saying, does the credit card have enough balance? So that information is relayed through this network back to the merchant bank, back through Visa, Mastercard, and the transaction goes through. All right. Let me quickly summarize again. So user has a card from some bank, right? Say HDFC Bank. He's doing this swiping on a different machine. If it is a HDFC machine, the story is altogether different, because if it's the same bank, they don't have to go through third party gateways, right? They directly go to HDFC gateway. All right. So I'm assuming this HDFC customer has swiped it at a different thing, like say ICICI machine. He has swiped on it. So that information is passed through the merchant website, through the merchant bank, through Visa and Mastercard to HDFC. When HDFC confirms that yes, this guy is an eligible customer and this card is valid and the balance is there, that information is relayed back and the transaction goes through. And all of this happens in split seconds, right? That is why there is a cost attached to it. So as you see, this is a complex process, right? Right. Who is paying for what here? Let's understand. So user has bought, say, suppose some goods at 100 rupees cost, right? So merchant is facilitating this through a card. So it's a facility for the user. So he is not liable to pay anything. So these gateways usually charge from the merchant. From the merchant bank. Merchant bank charges some amount to the merchant, right? Say suppose we've taken example of ICICI Bank, right? ICICI Bank machine. Since you have done a transaction on that, ICICI Bank would charge, say, suppose 20 paisa or 15 paisa on that 100 rupees transaction to the merchant. All right. From that 20 paisa, the merchant bank, which is ICICI, would also pay some share to Visa or Mastercard. Say, suppose 5 paisa or 10 paisa. All right. And merchant bank would also charge some marginal charge to the issuing bank because it's facilitating HDFC's transaction through ICICI machinery, right? So who is spending? Merchant is spending here, and who is spending? Issuing bank is spending. So issuing bank cannot recover this money from the user because it's a product that he is pushing. But merchant can recover this amount because he can price the goods accordingly. Say suppose if it was 95 rupees product, he can round it off and say 100 rupees for the transaction, right? That is how they can recover. So very complex system. Just wanted to let you know like how it is processed. Let moving on. Let's not spend some time here. All right. So coming back to the credit card life cycle, right? Acquisition is your first step, then account management, and then through delinquency, you go to write-off, which is losses, and then third-party sell-off. Let's quickly look at each stage. So credit card acquisition is a stage where you evaluate if the customer is good or bad, right? So standard credit, there is a credit score attached to every individual who has a in Indian scenario, every individual who has a PAN card ideally should have a credit score associated with him, right? In India, this score is maintained by CIBIL, which again uses Equifax data model for generating these scores. So let me quickly talk about these bureaus and FICO scores because these are critical to our future discussion. Okay. So let's establish the fact that there is a score. All right, there is a score that can tell if the customer is good or bad, and that scale is from 300 to 850. Right, if you are in the upper range of this index, you are considered to be a good customer. And if you have a fairly bad score, you might get rejected, saying you are not a worthy customer or we cannot extend our loan to you. Right, so that's the concept of having a score. And who maintains this score? There are certain credit bureaus. These are again third-party entities or individual companies by themselves. So the business model that they build is they house information from all the banks or all the financial institutions. And in the case of US, even your phone bills, your rental income, rental payments, everything go into your credit score, right? So credit bureaus, as an example, I'm not sure if you have heard of these names like TransUnion, Equifax, Experian. These are uh, very popular credit bureaus that maintain something called a FICO score. All right, and it's a fairly popular term in US, and every individual is aware of this FICO score in US. In India, it's called a CIBIL score, and you can actually check annually. You can check once for free on your CIBIL website. So, if you have any past history, I'm talking about specific to India. Like if you have previously taken any loan, personal loan or home loan or anything, or if you have any product like a credit card, you would definitely have a CIBIL score attached to your PAN card. All right. So that again is in the range of same range, 300 to 850. So higher the index, higher better the customer you are, right? So the concept here is if I am the customer, I am saying I need a credit card from you, XYZ bank, and my score is say 650 or 720. Based on that, they will take the judgment. But FICO score is not the sole deciding factor. there are few more checks like the fraud, similar to FICO score. There are fraud checks also. There is a fraud score, and there are companies who have established specifically to do this. And then you could, as a additional, you can also check your internal behavior score. Say suppose he's an existing customer, but he does not have a credit card. He has other products with you, say suppose personal loan or car loan or something. He has those with you, but not a credit card. You can still check his behavior score, how his payment patterns or everything that boils down to behavior score. This is an ancillary check. This could be optional, but the primary one would be FICO score, your application, and then mandatory checks. So usually, how acquisition happens is in the good and excellent bracket, right? These customers would automatically get approved. Like 98% of the applications in any bank would automatically get approved based on his or her score, right? Those that have fall under fair or some which are doubtful, those go through manual route. There are specific teams for that who uh, take a manual judgment, like they do a thorough study of your profile and decide if a credit can be extended to you or not. All right. So again, a new concept again here, which was introduced, was credit bureaus. Again, a third party entities, individual companies that maintain something called a credit score, FICO score to be specific in the US markets, right? All right. So what goes into those FICO score? As I said, your past payment behavior, right? So what comprises of FICO score, right? This is the breakdown of how much weightage is attached to each of your history. Say payment history has highest weightage of 35%, right? And then a lot of other things like credit mix, like how many products do you have, like do you only own one card or multiple cards across banks, that kind of a thing. And length of credit history, this weightage is higher in Indian market. So the longer you hold any product, the higher your score can be. And then finally, the amounts owed, right? This is your credit balance that you have, like how much you have spent on your card. Say 10,000 is your credit limit, and each month you are spending 10,000. Then this weightage kind of acts like a negative for you because you are using the maximum amount that is allowed, right? So payment history, if you're making timely payments, your score would be higher, or if you're defaulting or delinquent, your score would drastically decrease, right? So as I was saying, FICO score is very common to US customers, and they keep checking the FICO scores regularly. So that is how they maintain the credibility. All right. In US, it is to such an extent that even if someone is coming for a rental, they would also check the FICO score, right? If I am a landlord of some property, if I have to rent out, I will check the FICO score of whoever is applying for that rental. All right. So that is how popular credit scores are in the West side. In India, it's still a concept that is catching up, and I've personally checked my CIBIL score. It is highly inconsistent and it is not up to date also. All right, moving. Any questions so far? New concept, new terms introduced. Any questions? All right, I take the silence as no. Let's move ahead. So account management stage, we have discussed this, right? The customers are already on board. Like you already have so much of books. What do you do from here? Like how do you maintain that customers have certain specific spending habits? They're paying back on time. How do you ensure those? All that comes into account management. Sorry, let me stress again. This credit score is nothing but an index, right? Something like a stock index. So this could be a basic concept that you have learned in your statistics course. So again, coming back to account management, here is where all the meaty part of analytics lies, right? Lot of dashboarding, visualizations, reporting are developed in this stage, and uh, you also develop a lot of specific targeting strategies, like to improve your book credit ratio mix, like you have a certain amount of good customers, certain amount of average customers, and certain amount of bad customers, right? You want to have good customers more. So how do you make sure that you are improving this? All that strategies come under account management stage. All right. As an example, I've said this credit limit increase and decrease comes under there. And similar to what we have discussed, a FICO score, which is an acquisition score, right? We also have a behavior score. So this is again the same scale, 300 to 850, but the uh, input metrics change here. So in acquisition, where you're looking at across industry, how many cards you hold, history and everything. Here you look at slightly different metrics, like what is your spending pattern, what is your credit limit, and your timely payments, like payment history has a huge weightage here. And also, if you are holding a lot of uh, products, right? Like in US, it is common. Average credit card holding is 6 to 7 cards. Like every user would have 6 to 7 credit cards in the US market. So if you have more credit cards, how actively are you using? How many cards? That kind of information goes into your behavior score. All right. Fairly simple concept. Just a meatier part for the banks, or from a data analytics perspective. All right. So we talked about acquisition and account management. Right? Acquisition is where you are getting new customers. Account management is where you are maintaining those books, and you're trying to maintain them as healthy as possible. Right? Eventually, some part of your customers would go delinquent. All right. This is a table, but uh, it's a fairly simple one, so don't worry. So when I say no due here, I'm pointing to the table here under the delinquency. There is a no due. What does no due mean? These are all the customers. This is the volume of customers that are paying back on time. All right. So we have discussed this, right? You spend amount on it. There is a cutoff or bill date. From that bill date, you have a grace period of 21 days usually. So after 21 days, uh, you go into a next cycle, like you fall into this 0 to 29 dpd. All right. So if you have made that payment before this 21 days, you are a good customer. There are no dues from your end that are owed to the bank. All right. Usually this is the highest population of any. So this credit mix is maintained by banks across industry, right? So say you have missed 1 month payment, like this month you have used, you haven't paid back. That is called 0 to 29 days past due. DPD is nothing but days past due. All right. So you will be sent all these reminders, everything, and again your next billing cycle would come, right? After that next billing cycle, and after that next grace cycle, you would keep rolling into the next buckets. Like one payment you missed, this is the bucket you would be in. Two payments, three payments, four payments, five payments, and six payments, right? So after six cycles are passed and you're no longer paying, you would be considered as a loss to the bank. So if you have noticed the volume here, right? So this many customers have not paid in the first cycle, but this keeps reducing because customers, even though they're delinquent, they tend to pay back. Although their credit history is already affected because they have defaulted, they tend to pay back because they don't want to severely affect their credit card, the credit score, FICO score, right? It's a very sensitive issue there. So that is how the volume flows, and you usually see that very less population flows into what is called as loss booking or write-offs.
Navin,
Right?
Vamshi, there are a couple of questions.
Sure, sure. Yeah, go ahead.
So there is a question from Ananya. How does the issuing bank recover the charges?
Which charges? We're talking about this one, right? So yeah, okay, I got it. So issuing bank pays some amount to the merchant bank, right? That amount is not recovered. That is the cost to that company. He cannot go and charge the user saying you have used my credit card, pay me this much of amount. In fact, they encourage the spending pattern because that is advantageous for them, right? So consider it as a cost for them, cost of promoting the product. That will not be recovered.
There is a question from Rajeshwari, Miss Rajeshwari. Can you explain the demat account?
Sure, but let's finish this discussion because that would be a divergence from our topic.
So there are a couple of questions from Dr. Vemla Ramakrishna Reddy.
Sure, go ahead.
Difference between civil experience Equifax CRIF, are the differences due to only the data type that we consider for measure?
So yeah, you are right. You have answered your own question actually. So since these companies are different, right, the type of metrics that they take to build the model might differ. It will not be hugely different. Say an Experian building model and Equifax building model, the basic concept is same. They are trying to develop an index, but the metrics that go into building this score might differ. Say for example, if I am a bank, I might request, and this is an actual case, right? This is from Synchrony, where I used to work in the bank. So Synchrony goes to Equifax saying, I only need this particular 100 variables as input to my FICO score. So and Equifax takes these 100 metrics, transforms them, and uh, this model imputation happens, and then they come up with this index, FICO score. So this is built on only those 100 variables, right? So that is a custom FICO score that was built for Synchrony. So that is why, since the input is changing, uh, your index might also differ, but it will not be hugely different. Say if you are in the range of 800s in Equifax, you would not be shown as 600 in Experian. It would more or less in the same bracket.
There are follow-up questions
Sure, sure.
from Dr. Veman Ramakrishnan. So when somebody uses the full available money and not paying for settlement.
Sorry.
Yeah, when somebody uses full available money and not paying, why the banks are calling for settlement?
Yeah, so basically they're afraid that you are defaulting, right? They don't want to book you as a loss. So we'll come to that part, but we might not be able to spend a lot. So thanks for asking this question. I can address this here. Say you are a bank. So you are a bank, and in your portfolio, you are seeing like customers are doing maximum utilization and they're running off. So that is called hit and run. Usually, they usually spend the maximum allowed and then they stop using the product altogether. So banks are wary of booking these losses, right? Because there is a regulatory framework that banks usually work under. So in that framework, it is essential for banks to set aside some amount for these kind of scenarios, like where say you have 100 customers, you have to plan effectively, like how many of your customers. This is called adverse or stress testing. So what do you do is, after the 100 customers, you plan like maximum how many can default, and you set aside some amount of money from your capital. That amount you cannot use to grow, like you cannot introduce a new product, or you cannot use it in your paying salaries, basically your operational expenses or other things, right? That has to be set aside. So in your question, if someone is using to the maximum and then not paying, so the bank is wary, right? It has to increase its capital allocation for that losses. So yeah, they don't want to do that. So that is why they will immediately call you. If you're talking about Indian scenario, they will call you even before your last due date.
So,
Yeah.
the follow-up is, uh, is it pos- uh, is it possible to get credit cards after defaulting these type of after
Yes, in US scenario, once you default, your credit score goes bad, right? And this history is maintained for 7 years. It's a standard for US. So uh, we even within, so you don't have to wait till 7 years, right? Leave aside the traditional banks, you have lot of startups coming up, lot of people who are willing to give you credit. It's a very credit savvy market, right? They are willing to give you. So you can get some product from some startup, some lesser known companies, lesser known bank. Start building your profile again, right? Once you again climbed up these better buckets, and then you have restored your credit history, right? But usually it stays in the books for 7 years. So once they see that you have defaulted once, it would be a factor of accepting or rejecting. It has some weightage, yes.
So I hope it answers Dr. Vemla Ramakrishna's questions. And there is a question from Dr. Subhashin. What is the role of data analyst, data scientist, and data engineer? I hope in
Okay.
this.
In banking industry or in general?
I hope it is in this regards.
Okay. Okay. So that is a little bit divergent. So I'll answer it at the end of the session if time permits. Okay.
General, in general, actually.
Okay. So let's finish this credit card cycle and then we'll get to this question and the demat account. Okay.
Yes.
Sure. So continuing where I left off, this is the delinquency buckets, and this is how defaulters flow into, right? You would have maximum population in the node due, and then as you move to the loss-making buckets, the population would decrease. That is the usual pattern. All right. Say you have flown into that, right? This is the same table I've just converted into percentages because that is at the write-off stage. So I've combined write-off and third-party sell-off in this slide. So at the write-off stage, you develop certain models, right? Most of them are time series models. You develop these roll rate models, which effectively tell you like how much of your population is flowing from one bucket to other bucket. So say suppose you look at this column, right? Roll back and roll forward, right? Rollback is some customer is in delinquency buckets and he's moving to a better bucket. That is called rollback. Roll forward is your loss making. He's moving into loss making buckets. Like from a better buckets, he's moving to these defaulting buckets. So these percentages, these are developed, and since this is a fair, this is a monthly information that happens. So I cannot say monthly. This is cyclical information, right? Because each day there will be certain customers who will be billed, like from 1 to 28. Say 28 cycles. Each cycle would have certain number of customers. So this is a good time series data. Roll rate models, vintage analysis, all kinds of things happen. And the main reason why this happen is again to forecast your capital allocation. That is the primary objective. The other thing is you also need forecasts on your fees. Like you have all say some person is moving from no due buckets to due buckets, right? There is a certain amount of interest charge and fee charge that you have already charged to the customer in the next cycle, right? Once they go to the loss, so the loss amount cannot include these fees, and since these need to be reversed, you cannot also you have to factor that in for your capital allocation. So that calculation would change immediately. So for this reason, all this sensitive time sensitive data, a lot of forecasting goes into write-offs and third party sell off. So third party sell off is something that we covered already. Basically all the accounts you group them together, which you have absolutely given up on. No collection strategy has worked, nothing has worked, you have just written it off. So you sell it to third party for something. So instead of 100 rupees, you are getting 10 rupees or 20 rupees. That is good enough for you. All right. Um, any questions so far on the credit card life cycle, specific to life cycle? Otherwise, we can move ahead.
No, no.
Okay, awesome. Uh, I hope nobody is too disconnected to ask questions. All right. Let's quickly touch upon regulators in the US banking scenario, right? So it's a heavily regulated market. There is Fed Reserve is something like our Reserve Bank of India. This is a central bank. Uh, and then other things are basically regulatory authorities. So each person has their own individual what do you say, roles and responsibilities. Like OCC, this Office of Control of Currency, this guy checks like if you have not committed any frauds, or if you have an equal credit opportunity system going on in your bank. When I say credit opportunity, like you're not denying one person what you have given to other person, right? So that equality should be there. uh, so each person's this thing is defined. So I'm not going too much into it because it's a content heavy topic. Let coming to Indian banking
Uh,
scenario. Sorry, yeah,
Vamshi, there is a question related to the credit cards, and like
sure. Yeah,
the question is from Gaurav.
yeah.
In India, if you use whole credit and pay it on time, how will it affect the credit score?
Your credit score would improve immensely. So it would improve your CIBIL score because you are a good customer. So all the banks would want you. So I think he's asking basically from this, right? Amount owed. Uh, this would only slightly negatively affect you because if you're using complete amount, but your payment history has a higher weightage. Like if you are paying back on time, that also is a good sign, right? So your credit score would eventually move up. All right. Yeah, moving ahead. So, in the Indian scenario, these are the regulatory authorities specific to financial markets. So, RBI is whole and sole owner of the money thing. SEBI is, as you know, the stocks exchange and everything related to securities, right, including commodities. There is similar to IRDAI is pretty famous because of their frauds in the names of IRDA. They don't do frauds. A lot of people do frauds in the name of IRDAI. This is a regulatory authority for insurances. Similarly, there is a authority for pension and forward markets. This is a currency exchange market. All right. Quickly moving. All right. So another important topic when it comes to risk management, right, is Basel Accords. So there was a committee set up called in the city of Basel in Switzerland. So they named it as Basel. There is no innovation there. So uh, that committee has come up initially with a framework like what financial institutions should work under, and this is not a mandation, right? This is just a framework that they have developed. So if I own a financial institution, I can choose or not choose to apply those regulations with me. That was the earlier scenario, but later on, as the committees kept improving their framework. Like from Basel 1, they moved to 2, from 2 to 3. So all the financial institutions in the West are already on Basel 3. They are moving to something called Basel 3.5 or 4. So it's not very specific. There are very minor changes in what needs to be done. I'll come to what needs to be done here. And Indian banks had a 2020 deadline of adapting to Basel 3, but that had been extended, and this year is the last year that they can move on to Basel III framework. So initially it was not mandatory, but central banks started to pick up this framework. They might or might not do any changes to this framework based on the markets. Like in US, Fed definitely does some modifications to that framework, and it mandates institutions to follow this framework. So what does Basel 3 have, right? Similarly, in India, RBI has picked up this Basel as a mandatory framework for banks to follow, right? So basically, there are three main pillars that comprises of Basel 3, and all the type of risk that we initially discussed, like credit risk, market risk, operational risk, legal risk, everything would fall under these three pillars, right? And pillar one addresses that credit risk. Pillar one says you need to maintain your capital adequacy ratio. Like in adverse situations, you have to have so much of amount so that your business could run, so that your customers are not affected. Right? That is addressed under pillar one. Pillar two is basically this operational risk framework. Things like we discussed in PNB, right? Things like that should not happen. And pillar three is mostly dealing with market risk and liquid this thing reputational risk. All right. uh, so there's one point I wanted to touch upon. So Basel 2 was in effect when 2008 financial crisis happened. So in despite of so much of framework laid out, there still was a scope for such a global crisis to happen, right? So why did it happen? Uh, as I said, uh, regulatories are always trying to catch up to the products, right? In 2000 financial crisis, they created these financial products which were hard to interpret and which could bypass this framework, saying it would not fall under this framework, right? So so that everything is addressed and then put under Basel 3. So after 2008, there were major concerns. Yet we have not seen a global crisis because of this Basel III framework, because of the strength of the regulatory framework. The financial institutions are able to handle the adverse situations, right? So if you want to keep a track on uh, this student loan crisis is building up in US, where uh, the tuition fees and this has escalated, right? So common man is not able to afford it, so they are definitely going to student loans, and there is a huge pile up of few student loans already pending or due with the banks. This could be a concern, and they are trying to address. This is something you could hear in the next 3 to 5 years. Yeah. All right. So from this Basel framework come specific models that we work on in credit risk, right? Well, have I not listed? Okay. So these are called PD, LGD, EAD. So basically, what these enables as PD is probability of default, like saying a customer could default. So I'm so between 0 to 1, I would assign a percentage to him, saying this is the chance with which the customer might default. This is a basically it's a regression model that happens. All right. LGD is loss given default. So once PD is established, like a probability of default is established, I move on to how much loss would I incur if that customer is defaulting, and then this uh, there is a third model which is EAD, which is exposure at default. So what it means is within that loss, I am not liable to pay everything, right? So what is my exposure to that? So multiple of this in different combinations is uh, would define your capital adequacy ratio. There are again two frameworks. One is Basel, which all the banks follow, and some banks also follow IFRS 9. I've not listed it here, but PDLGD EAD calculation would still be the same. The multiple would differ for this Basel and IFRS 9. So basically, these are the data models that are used to arrive at a capital adequacy, right? Uh, so if you are interested, I can provide some background reading material to this. I think we are at the end of our session, and I've listed some free resources, SaaS resources for you to look at. I've not talked about tools that are used basically, but SaaS is 90% of the financial institutions still use SaaS, SAS, this SAS software for the data modeling, data reporting, and data visualization also. Visualizations right now they have gravitated to Tableau and Power BI, but for data analysis, still it is heavily reliant on SAS and SQL, right? So these are some resources. I'll share it with you. So that's it. We are at the end of the session. Any questions, discussions we can take up? Yeah, we have time, so I can address. If no questions, I can address DMAT and data analyst, engineer, and science differentiation.
Yeah, I think right now there no other questions are there. Yeah, you can.
Okay, sure. So first I'll address the DMAT because that was asked first. So DMAT account is your dematerialized account, right? So what is it? Basically, we have seen that. Sorry, just bear with me. So we have seen there are marketplaces, right? Financial marketplaces. I've listed NSE and BSE as an example. What are these NSE and BSE? These are marketplaces where you can buy or sell or trade equity. equity, when I say equity, these are the shares of a specific company. So as an example, let's take Reliance. Reliance is, as a company, has issued so many shares to the public, right? If I spend like 1,000 rupees, I can buy one share of Reliance, and I would be official shareholder of that company, right? Earlier, before this demat account, so how this process was all paper based, right? You had to go to certain place to get this, buy these shares. It would still be BSE during that time. So you had to go to BSE and to a specific broker, stock broker, saying I want to buy Reliance share for this much amount. They would do this legal document and give it to you. That would act as your copy of share, right? So a lot of fraud happened in this paper-based model because just like real estate, right? You can just make a copy of your legal document and claim that share. Uh, that is one kind of fraud. So other thing is more than an allotted number of shares, there were legal documents for them. Say suppose a company had 1,000 open stock shares for public, there were more than 1,000 legal documents claiming for those shares, right? These kinds of fraud were very prevalent in paper-based economy, paper-based transactions. So what government has done, specifically SEBI, they have introduced, they have dematerialized. Basically, the word is they've done away with this paper model. So these shares would be digitized. There was a long transitional period for this to be done. You can still do it today if you still have this paper based share, you can still approach, there are processes for that. And what they have done is they have not removed the broker per se. Brokers are still existent, and you have to buy or sell a stock through the brokers only. So when I say broker, it's not the BSE or NSE. There are registered brokers with BSE or NSE who act as a um, uh, let's say kirana store, right? For grocery, how the kirana store is, but they don't own the grocery, right? They get it from somewhere and sell it to you. In a similar way, these brokers are the kiranas of stock exchanges. All right. So you pay all your paper-based shares were converted into dematerialized form or digital form. So for that, to house that, you had to add an account that is called a demat account, and each broker had come up with their own way of working. Private players like HDFC, they still charge a bomb for each transaction. And recently, with recently we have seen Zerodha or Upstocks. You might have heard of these companies, right? They have come up with these are called discounted brokers. Basically, they don't charge on each transaction. They only work based on your annual charges or maintenance charges, right? Basically, an account that you hold with these brokers to facilitate your stock buying and selling is called a demat account, right?
Okay, Vamshi. I think there are no questions from the audience end. Thanks a lot for this extensive talk on how the finance industry, on how you have segregated the finance industry for modeling, for giving a data
Sharath,
point.
sorry, I think you're concluding. So there was one more question on difference between analyst, scientist, and engineer,
Yeah.
right?
Sorry. Yeah, sorry. Yeah, please carry
Yeah.
on.
Okay. So basically, it's very minor. The change is very minor, but as companies are evolving, the change is becoming more and more prominent, right? So, 10 years ago or 5 years ago, if you say data analyst, engineer, or scientist, it would point to the same person, right? The person who was handling data, who is taking some insights from the data. But what has changed is with the you've seen this data revolution, right? Data has exploded, right? So right now, specific functions have been divided into roles like analyst, scientist, and engineer. So I'll start with data engineer. What data engineer does is he is a person responsible for providing the data. Like he might be having multiple source or avenues of data coming from different things. So even if a data analyst or data scientist asks, is working on some analysis or some modeling, he would approach a data engineer saying, I would need a data in such and such format, and it is data engineer's job to provide that data to these two guys, right? And what data analyst does is, in most companies it's the same, but in some companies data analysts purely do reporting and data visualization kind of work, right? Basically insights generation, deriving actionable insights from whatever analysis anybody is doing, or the visualizations. It is all part of data analyst role. And data scientists are the guys who have the liberty of working with or innovating products or doing the data modeling. So uh, basically, how do you say, they can, they have the luxury of spending time to come up with a different model or a different tools or techniques, right? So that's the only primary difference. Otherwise it would still be the same. Any follow-up questions, or did I answer your question?
Yeah, I hope that was question by Dr. Subhashin. I hope it is,
Okay,
yeah, it is
sure.
answered. Uh, yeah. Any other questions from the audience?
I
Uh,
hope people have not slept off.
no. It was a very interesting talk, and it was you have spent a lot of time on explaining it in detail. So there was no.
Yeah, that's the
I
worry
was
because it's a monologue, right? I hope people have not slept off.
no.
That's okay.
So
That's
I kind
it's
of
fine.
find there was
Yeah,
no blank spaces where I kind of drifted off. I could understand each and every aspect which you were trying to say. What?
awesome.
Yeah, there is one question from Ratnadeep.
Yep.
So, what kind of models are generally used in this sector?
So banking industry mostly relies on linear and logistic regression, right? Logistic because from the what we have discussed so far, this probability of default, everything is a logistic regression. And when you're discussing, even in the marketing side of, we haven't gone into marketing at all. Even in the marketing, that you do heavily do logistic regression usage. Like if you're running a campaign per se, if that customer would convert or not, it's a 0-1 question, right? Or saying you are rolling out this credit limit strategies, would the customer accept or not? These are all 0-1 questions. So logistic regression and predominantly linear regression. Also, we also use this clustering problems a lot for cross-selling or uh, product, basically marketing side. Clustering is very famous.
Yes, thank you, Vamshi. What about the time series models? This is the follow-up question from Ratnadeep.
Yeah. Time series models we discussed, right? So time series is majorly used by only the loss part of it, or the collection guys who have to track a history of payment history kind of stuff, right? In credit risk, I mean, in the earliest stages of the credit risk and all, time series is not very much predominant. Only in the loss forecasting section, yes.
So I hope it answers Ratnadeep Pal's question. Uh, Yeah. Dr. Subhashni says it is a very nice explanation, and it's like awareness creating speech. Thank you. I do agree with it. I really like the session. I hope it does that if any one of you has any more questions, participants, please let us know. Otherwise, we can conclude this session.
Sure. Yeah. If you have any questions after the session, also please reach out to Sharath. He can get in touch with us. Okay.
Yeah, sure. Okay, yeah, Vamshi, can we have your email address for the participant to share their queries?
Sure. I'll drop it in the
Shall I
chat
ask you
box.
later or yeah?
No,
Okay.
it's fine. I'll drop it in this. So if you get if this email ID is lost, you can still get in touch with Sharath. He has my email ID.
Okay, so even funny sir is also commenting nice session. So I also would like to thank Vamshi. Thanks a lot for taking the trouble and doing
It
it
was a
such a
pleasure.
long.
Thanks for having me. Yeah,
Yeah, it was
yeah.
a very big
Let's feel.
session. You actually took a lot of time in explaining all the details and all the aspects which are needed for modeling this data. I feel that everybody has got it. And I from the morning session, morning we had a session on R, and afternoon we had a session from Praveen from the Novartis team itself. So he also has taken the time in detailing all the aspects of how people analytics is dividing all the aspects in order to model it into a data problem. So it is a very I feel that this today's session will give a we hope that today's session will give an holistic understanding on how data science can be implemented in people analytics or in finance. Thanks a lot. Thanks a lot for being patient and answering all the questions, taking a lot of time and going at a very comfortable pace. Thank you, Vamshi.
Yeah, thanks, guys. Thanks for having me. Thanks for your presence and patience. In case, again, reiterating, if you have any questions also, please reach out to me on directly on the mail or through Sharath. Anything is fine. Okay. Yeah. Thank you.
So all the participants, I have shared a link to get your feedback regarding the today's sessions. So please try to fill it at your convenience. And yeah, tomorrow's session will start at 11 o'clock. I have shared the schedule in your email ID. Maybe I will send you a reminder in case someone has missed it. So tomorrow we have three sessions. One is scheduled at 11 o'clock, okay, and another is scheduled at 12 o'clock, and the final session is scheduled at 4 o'clock. These are the three sessions which we will be having tomorrow. And tomorrow's first session will be on fundamental concepts in Python programming for data analysis. That will be taken by Dr. Aswin, a postdoctoral fellow, ISER Trivandrum. And the later session, the first session of the afternoon session, first lecture of the afternoon session, that will be telling a story with data. This is a walkthrough of the experience of a co-founder, Mr. Ram Tier. He is the co-founder of Predictly, so he will be walking through his experience with the data. And the final session, which is at 4 o'clock, it will be on evolving shop floor manufacturing intelligence, leveraging data science technologies. This session will be taken by Mr. Ramakrishnan Ravishankar. He is the Director and Chief Innovation Officer of Cantier Systems. So I hope the next upcoming sessions will also be as you as yeah as interesting as the previous session. I hope these today's sessions are also interesting. So please try to share your opinions. It is an anonymous form, so you can fill in whatever the suggestions you would like to comment, or whatever the improvements you would like to have in the future workshops, obviously. Yeah, please feel free to comment in it. Yeah, thank you all. If you have any questions regarding workshop schedule or anything else, you can feel free to ask me. Otherwise, we can end this session. Yeah, so there was one, I was following through the comments. So uh, there was one question that I'm here not for the domain knowledge. I'm here how using the domain AI has been affected, but that connectivity was minimal in having. So the thing is, yeah, see, this is anonymous. I just want to comment on this. The sessions are basically constructed in such a way that we have some sessions where you will get the technical knowledge, and some sessions where the like in the last two sessions, people analytics and as well as finance, you got the glimpse of how to structure the knowledge or the data in order to apply the data science, in order to apply the data models. Okay, so that structuring was given by Mr. Praveen Kumar and also by Mr. Vamshi Krishna in their own respective fields. So if you have anything else to if you feel like to add something else, or if you're if I'm not getting your question properly, please try to contact me at this email ID I'm providing you, so that if possible, we'll try to make an improvement in those regards. The email ID, so you can personally contact me and let us discuss. So for the sessions that we are not able to attend, will the recording be made available? Unfortunately, the recordings may not be able to not be available because of the copyright. The stuff which speakers are sharing, we need to get proper permissions from them, and we are not sure whether they are available for like distribution. Okay, so please try to attend all the sessions, and hopefully once if we get permissions, then maybe we will make it available. But don't rely completely on it. As you know, Vamshi has mentioned that he need to get the permission from Axiom AI Solutions before. Yeah. But luckily he has made us record the video. Hopefully it will be available. Okay then. Uh, if there are no other questions, no other queries, we can end this session. I will send you a reminder mail regarding tomorrow's session. Actually, you can use the same link for all the sessions. Okay, we are having the same link, or single link for all the sessions throughout the workshop. So yeah, just look at the timings and join the session. Okay. Okay. Yeah. If you don't have any queries, you can leave the session. Thank you all. See you tomorrow.